Good morning, traders. With the very important GDP coming out tomorrow from the Great British Pound, I thought let's do a video on the gross domestic product. Now, this video is based on the GDP overall, which will work for any of the different currencies that are out there. So if you have missed the event that I'm talking about, no problems. The video will still help you out with future events. The first part is, what is it and why should we care? Well, the gross domestic product, or GDP, is a fundamental economic indicator, and it's one of the most closely watched indicators by Forex traders. Furthermore, both influential data's initial release and its subsequent revisions can often result in wild swings in the Forex market. The level of the GDP is commonly used by economists and fundamental traders to assess the level of growth and economic health in a country's economy. The data can be used to provide a sense of the standard of living inside a nation. So it's a very good indicator to show the overall feeling of how things are going within a country, but what does it measure? The gross domestic product indicator is typically expressed on an annualized basis, and it measures the overall value of the productivity of an economy. GDP can be computed in three ways known as the product or output approach, expenditure approach, and the income approach, which should all theoretically yield very similar results. Specifically, the GDP for a country includes the production of goods in its economy as well as the value of things such as investments, services, and trade balance. The data also includes government and other public spending. GDP differs from the gross national product in that it leaves out the overseas profits of domestic firms, in addition to the earnings reinvested in the foreign-based operations of domestic companies. The changes seen in the GDP can have a large effect on an economy. When the GDP of an economy is rising, the country will often see businesses expand and hire more staff in an attempt to keep up with growing demand for their products and services. Also, more goods will usually be exported, and the country's business cycle improves to reflect the expanding economy. On the other hand, a declining GDP tends to signal an economic slowdown in a country. The demand for products and services tends to be reduced during such periods that show a contraction in the GDP or negative GDP growth as the business cycle moves towards recession. So basically, the GDP indicator provides economists and Forex traders with one of the most important pieces of information with which to gauge if a nation's overall economy is growing healthily or contracting in a recessionary business environment. The GDP indicator usually signals a strong and healthy economy when it is growing at an annualized rate between 3 and 3.5%. At such moderate growth levels, the GDP will not usually signal that too much inflation may result, although higher growth levels could signal excessive inflationary pressure building within the economy. On the other hand, lower growth than that is often seen as a signal of weak economy, while a negative number is considered recessionary or even a signal of depression. Specifically, if a nation's GDP declines for several months, then that is considered a temporary recession. But if it falls by more than 10% for several years, then that indicates an economic depression for the country. The GDP has a top-tier reputation as one of the most closely watched of all the key fundamental indicators. Both its initial release and its revisions can result in significant financial market activity and exchange rate fluctuations. Basically, when the gross domestic product data for a country comes out higher than the market was expecting, then that is usually positive news for the currency of that nation. Buoyed by such good news, the currency will often subsequently appreciate relative to other countries. On the other hand, when the GDP for a country comes out lower than what was expected, well, then that's negative news for that currency, and we will often see the currency depreciate relative to other currencies. Central banks such as the US Federal Reserve Bank often use the level of the country's GDP to determine the nation's economic strength, since it is an especially broad-based fundamental economic indicator. The level of the GDP for an economy can have a significant impact on the monetary policy decisions made by that country's central bank. As a result, the important GDP's data release can prompt substantial exchange rate movements, and it can also significantly influence stock market valuations and bond prices. Just to summarize what we've spoken about here, The GDP is a way of measuring the overall strength of an economy by showing how fast is it growing, specifically in the private sector as well as the government sector. Now, if we see that private and government are both growing and we're seeing more people being hired, with more people being hired, there's lower unemployment. There's more money floating through the economy. The government can draw more taxes. Things will be looking good. As long as an economy is growing at a steady rate, then we can very often see that as being a good thing. Now, if the news comes out saying it's actually better than we expected, well, then that's amazing. People are going to start jumping in, and we'll often see the markets move up very quickly. If the news comes out being worse than what was expected, well, then that's obviously a bad thing. And we very often see people pulling money out of that economy because it's not as strong as what they had expected. And this is where we as Forex traders jump in and we try and trade that either long or short based on how the GDP is coming out and how it's different from what was expecting. Those violent swings that people run away from, that is what we go for. I hope this clears things up, and guys, make sure you at least watch it. Even if you're not wanting to trade, just have it open, go to jpmarkets.co.za, look for the economic calendar, watch the result come out while you have the charts open, and you'll see some very fun movements.